Bismillahirrahmanirrahim. Assalamu alaikum, dear students. Welcome again to a new lecture in lieu of the lecture series on monetary and fiscal framework and Islamic finance. As you know, the code of this course is MBF707, and this lecture series is coming from ComSat's Institute of Information Technology, Virtual Campus, Islamabad. Dear students, today we will discuss fiscal policy, Islamic versus conventional frameworks, how conventional fiscal policy is different from the Islamic, or the other way around, the Islamic fiscal policy or fiscal policy and Islamic framework is different from the conventional perspective. This topic is extended over basically 2 lectures. So in the first lecture, we'll discuss some basics from the conventional fiscal policy and the Islamic framework. This lecture may also be considered as an extension to the Faridi model, which we discussed in detail in the last 2 lectures. So students, before we formally start the topics related to the Islamic concept of fiscal policy versus conventional fiscal policy perspectives and dimensions, let us very briefly and quickly review what we have discussed in the last 2 lectures. In the last 2 lectures, we discussed Faridi model, basically the Faridi's concept of fiscal policy. The Faridi model may be considered as a fundamental model, in a way the conservative approach to the fiscal policy in Islamic framework. In the introduction, we discussed how the Islamic concept of fiscal policy arises, and then we discussed certain elements of the fiscal policy, certain constraints faced and confronted in the Islamic framework while dealing with the conventional economic system. So while functioning in the Islamic conventional economic system, there are certain constraints which are usually confronted by the economists who strongly believe in Islamic framework. So it is not so easy to implement the Islamic fiscal policy in the conventional framework until unless there is a willingness to accept the Islamic dimensions of the fiscal policy, which is intuitively linked with the monetary policy. So this course is therefore justified in the context that fiscal policy and monetary policy have been clubbed together in this course, and the title of this course that is why has been nomenclatured as the fiscal policy and the monetary policy. Faridi suggested 3-sector model. We discussed in detail, and the allocation function he has emphasized, and the role of government, which we deliberated in detail. With respect to the 3-sector model suggested by Faridi, we discussed Faridi's suggestions in respect of 3-sector model as number 1, private sector, and number 2, in comparison with the private sector, there is a public sector. And one more sector as a big perspective has been added by Faridi, which is known as the voluntary framework. Now this voluntary framework basically does not exist in the conventional system per se, but it is intuitively part and parcel of the Islamic fiscal policy, which is in a way a religious obligatory with the name of zakat, which is levied on every sahib-e-nisab, the person who holds certain amount of money in accordance with Sharia, according to the Sharia specification. And if a person is holding the assets in accordance with the nisab, then he is levied a certain rate of zakat. Usually it is 2.5%. Now this 2.5%, there must be some hikmah, some justification. But whatever justification is there, we as believer are not allowed to question this, because this is the matter which has been deliberated in very detail in Quran. And in Sunnah there are a number of ahadith, sayings and the practices which guide us in the implementation of the zakat system, either in terms of the monetary assets. If the nisab arises, the zakat is to be charged. And even in case of agriculture produce, a certain amount of zakat is to be paid. Now all these things are detailed. Allama Yusuf Qaradawi rahmatullah alayhi has written a masterpiece in respect of the distribution of zakat, levying of zakat, and different heads where zakat can be levied, different sources of income, different sources of revenues, and different types of wealth and assets where zakat can be levied. So students, if you are interested in studying the system of zakah from Sharia perspective, where and how much the zakat is levied, you can study Yusuf Qaradawi's book, which has also been translated into different languages. And I hope its excuse me, I hope its translation into Urdu is also available, but its English translation is luckily available. So you can either Google this book in search of the e-book, or you can purchase it from the market. This is one of the masterpiece in the determination of zakah on different commodities, in terms of different commodities, on different assets, on different types of savings, on different types of produce, and on different types of economic activities which generate income and revenues. So in sum, we summed up these two lectures as to the emergence of zakah as one of the key variable in the fiscal policy. And as I mentioned earlier, regarding zakah, you can study its religious details from different books. Though its explanation is given in Quran and Sunnah, but further detail, Fuqaha has done a lot of work in this connection. So voluntary institutions, private sector, the role of voluntary institutions, we study. The role of voluntary institution is basically to bridge the gap between the private sector and the public sector alike. So students, so how voluntary sector bridge the gap? Private sector, yes, in conventional system, the private sector functions or is involved in economic activities with the pursuit of purely economic profits. But in Islamic framework, yes, the private sector is allowed to pursue this as one of the objectives, but at the same time, the satisfaction from the Islamic principles is also imperative. Public sector generally provides the goods, the services which private sector either fails to supply at low cost or to supply limited quantities of such goods and services. As an example, we discuss the education and health in particular in detail. So voluntary institutions therefore can play their significant role in providing the services like health and education and the goods of different types to the community, either on voluntary basis or in terms of donations or in terms of charity or in terms of some running institutions which regularly receive charity and provide goods and services to the needy people, or they provide temporary or ad hoc jobs to the private individuals. So there is significance of the voluntary institutions. Then in terms of equilibrium, we discussed that it is not the equilibrium in pure material and the metallic form. It is not the calculated form of the balance on the right hand side of the equation and the left hand side of the equation. Rather, equilibrium in Islamic framework means a balance between the worldly affairs and the feelings and the responsibilities towards the world hereafter. So students, therefore, now having concluded the last lecture, let us now come to the point where we are supposed to start the new lecture. So the agenda of this new lecture is as follows: introduction, as usual, some new dimensions of fiscal policy when we introduce it, and then fiscal policy in conventional perspective. Then we will discuss in detail the Keynesian theory, one of the leading theories which plays significant role, which actually brought about the structural change in the macroeconomic framework after the World War. So Keynesian theory, when Keynes wrote the book on general theory, his contribution was considered as a masterpiece in macroeconomic framework. And then the Islamic perspective of the fiscal policy we will discuss, and how and where in the Keynesian model the Islamic variables can be incorporated. Early Islamic period, how the early Islamic period dealt with the concept of fiscal policy, how the fiscal policy emerged, and then we will conclude our lecture. Students, now according to the agenda, defining the fiscal policy, in the last lecture we discussed different variables of the fiscal policy, zakat, taxes, and in conventional economics it is the tax, government expenditures, and the government revenues. As you know, fiscal is the word from fisc, which means the revenue collection, the policy of or the measures taken in lieu of collecting revenues for the government, and then the management of these revenues in respect of different expenditures. Obviously, these expenditures include long list in respect of non-development expenditures of the government and the development expenditures of the government. So main purpose of fiscal policy are generally so many, but some of them can be listed below, which are commonly pursued in both Islamic and the conventional framework. So when and where I feel that the difference should be clarified between the Islamic goals and the conventional economic goals, I will do. So main purpose of fiscal policy are: number one, to achieve economic growth without inflation and unemployment, and number two, achieve equality in income distribution in order to reduce gap between rich and the poor people. Now the first one, economic growth without inflation and unemployment. The story in conventional economics is very interesting. what happened in the early period, before the World War, it was believed that the conventional system works automatically. Supply creates its own demand, and if there are gaps, these gaps are automatically filled. For example, how the gaps arise? The gaps between the expenditure side and the income side arises when people at certain level, when certain component of the people starts saving. So if they are earning 100, but they are spending out of this 100 just 60 or 70, and they are saving the remaining amount, say 30 or 40, this 30 and 40 which is not coming back to the business cycle activities, the cycle is therefore broken. And when this cycle is broken, and then in the second round, the demand for the goods and services is not generated to the extent of 100%, it is generated only to the extent of the expenditures taken by the people. For example, if people spend 60% of their income, the demand has been generated only up to the 60% to meet the 60% of the consumption demand for goods and services. According to the classical concept, the 40% which is saved, which does not come back to the system, it takes time, but ultimately, automatically, it has to come back to the system of the business activities, and therefore automatically the saving investment gap will be filled and there will be no problem. So if there is any problem of unemployment in the classical system, that would be a temporary phenomena, and this temporary phenomena, although creates trouble and gap, but in the long run, this gap is automatically filled. The system reinvigorates in such a way that the gap is automatically filled. Students, then after the World War, a very common relationship which came into being, it was the Phillips curve phenomena. The Phillips curve phenomena inversely related the unemployment and the inflation. How this relationship, how this trade-off relationship between unemployment and inflation was developed. So basically, the reason, the explanation for this trade-off has been given in these words. If the economy pursues the objective of high economic growth, it has to arrange investment in the economy, and when investment activities are undertaken, through multiplier effect, the national income increases, and when this national income increases, the demand for goods and services increases because people are now earning on account of created economic activities through investment. So when people earned and they start consuming, in fact, they raise demand for goods and services. Intuitively, this rising demand for goods and services raises the general price level in the economy, which is known as inflation. So this is how, by controlling the unemployment level through fiscal expansion, the inflationary situation is confronted at the end of the day. So this negative relationship, this inverse relationship was propounded through Phillips curve explanation. The second, achieve equality in income distribution in order to reduce gap between the rich and the poor. Now this equality, another goal of one of the purposes of the fiscal policy is redistribution. The statement listed as B. How to explain it? Equality, basically, one of the objectives or the purposes of fiscal policy is to collect taxes from one component, which is the rich component of the society, and redistribute it among have-nots. Have-nots means the poor people, those who cannot afford many goods and services. So the realization was that taxes would be collected from the rich people, and after having collected these tax revenues, the government will launch different projects for those who are included as have-nots in the society. So now this equal distribution, Islam does not believe in equal distribution, because equal distribution is something which ignores the productivity level of the individuals. It assumes that all the persons are equal in terms of capabilities, in terms of their productivity. So therefore, what Islam emphasizes is the distribution of resources according to the productivity. So if a person is more productive, more capable, if he has learned the skills to contribute more in less possible time, to produce more in less time, he deserves more rewards than the person who is less productive, who is less skilled, who is less capable than the first one. So this is the difference. Now coming to the types by which the fiscal policy can be categorized, or the fiscal policy is implemented, or the fiscal policy is generally considered. The first perspective is fiscal policy functioning as automatic stabilizer. Then the fiscal policy as a discretionary item for the government or for the public sector. Well, fiscal policy tools as automatic stabilizers. What are the fiscal policy tools which function as automatic stabilizers? First of all, let us understand what is a stabilizer and what is an automatic stabilizer. You must be familiar with the electric stabilizer, the power stabilizers. A number of electric appliances, for example, refrigerators, television, or other sensitive electric appliances which function, which are used in our houses or in our offices, they need protection from the electric shocks. For this purpose, the stabilizers are basically connected to these electric appliances. So Pakistan, having severe shortage of energy resources and facing the issues of load shedding, this power failure or electric shocks is the normal practice. So the electric appliances are therefore always at risk. They are always at stake, because as a result of load shedding, either power supply may decrease or power supply may increase due to so many other reasons. For example, the wires which are being used by our electric supplying system, they are not reliable. The government managers claim and acknowledge that if they increase the power production, the wire system, the distributive system of power supply is not reliable. It cannot bear the load of the extra production of electricity. So therefore, we need to put some electric stabilizers with the electric appliances so that in case of electric shocks, our electric appliances remain totally secured and protected against these shocks. Now, well, after understanding the system of automatic stabilizer, how fiscal policy functions as automatic stabilizer, that is very interesting discussion. Under the fiscal policy, under the umbrella of fiscal policy, we charge different types of taxes as the government or as the state. These taxes are of different types, can be progressive taxes, can be proportional taxes. And then we also experience the price ceiling and price flooring. Price ceiling and price flooring is perhaps not the strong reason to function as automatic stabilizers because sometimes these practices are considered against the principles of Islamic economic system. So therefore, we will focus more on the tax system. So progressive and proportional taxes. What is the progressive tax? In a progressive tax, the high income people are basically called for the contribution, for the more contribution, relatively more contribution towards taxation. When people cross the income bracket from lower to higher, they have to pay taxes at higher rate. For example, if they fall in the income bracket of say 20,000 to 30,000 per month, suppose they are levied taxes at the rate of 5%, but if they cross this bracket and move on to the higher income bracket, they are called for to contribute at the rate of 7% or at least more than 5%. Such a tax system is known as progressive taxes. And proportional taxes mean when tax rate remains the same, automatically if the tax base increases, people have to pay more amount of money according to the proportion, according to the rate of tax, according to the proportion of the tax. For example, 10% tax, it will remain 10% irrespective of increasing income or any other head where this tax is levied. Now, if you calculate the tax amount paid by different people, suppose a person is earning say 200,000. So he has to contribute at the rate of 10%, 2,000 rupees. 20,000 rupees. If he is earning 200,000 at the rate of 10%, it will be 20,000 rupees as a tax. But what about the person who is earning 1 million? So 1 million at the rate of 10%, it comes out to be, you see, it increases. So it means the 100,000. So 100,000 is to be paid as a tax. You see how the amount varies, but the tax rate remains the same. So in short, in progressive tax, the tax rate increases with the increase in income bracket, whereas in case of proportional taxes, the tax rate remains the same, but as the base increases, the tax base increases, people contribute more in terms of absolute amount. Now, how do progressive and proportional taxes function as automatic stabilizer? These taxes function as automatic stabilizers in the sense that if there is expansion in the economy and the income level is increasing, the economic activities are booming, then taxes, what will happen if there is no tax? Every penny earned will generate demand for goods and services in the economy, and this will put pressure on the production side or the productive capacity of the economy. I repeat it, if no tax is paid, 100% earning basically has the claim of 100% expenditures, because when you are earning more and every penny is becoming the disposable income, it means you can buy goods and services freely. So this will put pressure, demand pressure on the economy. The demand side will be increasing all the time. And on the production side, in order to meet this demand, the productive capacity plays a very important role. So generally, productive capacity does not expand so swiftly and so significantly as the income, at the pace of the income or the aggregate demand. Now, in order to curtail this automatically, if taxes are in the system, for every $100 earned or for every 100 rupees earned, people will have to pay part of it in lieu of tax. So when they pay tax, automatically their income is reduced. Suppose 10% tax on 100 will reduce their income to 90. So instead of having 100, now people are having 90 rupees. So at least demand has been curtailed by 10 rupees. So this is a very small amount, 100 rupees is a very small amount. If you expand it to the bigger amount, so can you imagine in cumulative, the demand will be reduced significantly. At least the burden and the pressure on the aggregate demand and then the burden and pressure on the productive capacity of the economy is also lessened or reduced. So by slashing this burden on the productive capacity, we did not do anything. The system did not do anything. Just within the system, there was built-in practice of paying tax. So taxes automatically curtailed, it capped the aggregate demand to an extent, and the productive capacity is not overburdened, and therefore the inflation does not increase as much as it would have been otherwise as a result of increase in 100% increase in demand. So this is how the system works. Similarly, at the time of recession, when the economic activities slow down, people are earning less, their income level is decreasing, and they don't need to pay tax. They don't need to pay tax. So their actual amount of income is spent, and the aggregate demand is increased 100%. So the income does not fall so swiftly as it would have been otherwise in the absence of the tax system. So now coming to, there is one more. In Islamic framework, there is another automatic stabilizer which is not listed here, that is transfers. So transfer payments also function as automatic stabilizers. In Islamic economic system, very strong automatic stabilizer is the system of zakat, the institution of zakat. During the recessionary period, when people still continue receiving zakat, particularly those who become poor or who are covered under the category of zakat recipients, so if they receive zakat, the economic activities will continue because they will be receiving zakat and they will be spending out of it. So the spending, which is the source of multiplier, the multiplier effect will continue to persist, and national income does not fall as much as it would have been otherwise in the absence of the transfer payments or the zakat. So in Islamic framework, the transfer payments like the religious obligatory zakat or infaq or voluntary payments or charity, this type of things, they function as the automatic stabilizers at the time of recession particularly. Similarly, in case of boom, since the income level is increasing, most of the people are counted towards the zakat payers instead of zakat recipients. So similar to the progressive and the proportional taxes, when people at the time of boom, they basically they cross the limit of zakat recipient to the zakat payers, because most of the people at the time of boom will be included in the list of zakat payers. So when they are paying zakat with certain proportion of their income or the earned or the revenues or the savings or the assets, the aggregate demand on the part of this category, which is taxpayer, does not increase as much as it would have been otherwise in the absence of zakat system. So again, there will be less pressure put on the productive capacity of the economy. And the economy with the Islamic obligation, the economic activities remain protected. Now, discretionary fiscal policy is basically on the functioning of the fiscal policy. So, how do fiscal policies function? Fiscal policy can function either in terms of contractionary activities or in terms of expansionary activities. What is contractionary fiscal policy? Contractionary fiscal policy, when we take different measures in respect of fiscal policy which curtail economic activities, which reduce the size of multiplier, and the multiplier effect is reduced, the national income does not increase as much, rather it is decreased. So this is known as contractionary fiscal policy. For example, later on in the subsequent lecture, we will I will introduce you the multiplier and its relation with the marginal propensity to consume, and then you will see how the multiplier effect actually increases the national income of the economy by much more than the actual amount invested in the economy. So contractionary fiscal policy is when the investment level is decreased either by the public expenditures, the government curtails its expenses on the projects, or the projects are closed down, or the money even is withdrawn, or the government is putting heavy taxes, government is levying or imposing heavy taxes. So by the imposition of the taxes, the purchasing power is reduced, consumption process is curtailed, and there is less demand created in the economy, and this less demand ultimately causes less production in the economy on the supply side. और इसका नतीजा क्या होगा कि output will be reduced, national income is reduced. This is contractionary fiscal policy. As a result of this, the employment opportunities are curtailed, unemployment is likely to increase. Whereas on the expansionary side of the fiscal policy, reverse is the case. If public expenditures are expanded, more job opportunities are created, and people are earning more, they therefore spend more. As a result, the employment opportunities are created, because in order to produce more goods and services, we need more factors of production to employ. So this is how the expansionary policy functions. There are two approaches to analyze fiscal policy. First, the governing laws in the economy. Keeping in view the governing laws in the economy, there are two ways to consider the options of fiscal policy. Number one is, we have to look at the economy from its governing laws, whether it is based on Sharia principles, purely Sharia principles, or the second option is we have to look at the governing law and see whether the economy is functioning as a mix of the Western law and the Sharia principles together. So in certain aspects, the Western law prevail to function, and in some other activities, the Sharia principles are strictly followed. The first approach will be the natural choice of Islamic economy, because Sharia is the base to provide law, to provide solution, to be the part of any macroeconomic framework. A lot of research and investigation has been done in extracting information, the knowledge from real economic life. In Pakistan, Malaysia, governments have power to control zakat collection and the disbursement. So if on the part of the state, when we are not, even if we are not following Sharia principles to the extent of 100%, as the case of Malaysia and Pakistan, but Pakistan being the Islamic Republic of Pakistan, we have law, we made law in 1980s to collect zakat by the institutional manner. And by the institutional manner means now zakat is deducted at source, and the source was declared as the financial institutions. So in the financial institutions, if you are holding some deposits on the first day of Ramadan, the financial institutions, according to the guidance of the government managers, certain amount is declared as nisab, and then according to the zakat rate, the zakat is deducted from these deposits. And Pakistan Zakat Council and the other institution then redistributes this zakat according to their own way. In Pakistan, this zakat is distributed by the system of local zakat councils. So we have at the federal level certain zakat system, and then at the local level we have the zakat councils. And these zakat councils collect the data and the information about the recipients and about the potential recipients of zakat. So they collect information. This information is then passed on to the authorities to register zakat recipients, and then local zakat council receive money out of the zakat collected by the government, and then people regularly receive zakat money. And a survey is also conducted in order to see whether the effect of zakah has been positive or negative on the lifestyle of the recipients. And according to my study, in one of my research papers, I found out that the distribution of zakah in Pakistan has not created much difference because people have developed the habit of receiving zakah, and perhaps there is a need on the part of the government to improve it in different ways. One of the suggestions is that this zakat money which is collected should be used to develop small scale industries or small business enterprises where the zakat recipient, the potential zakat recipient, can be given job opportunities to earn regularly. So this way it will be an addition of the stock of capital to the national economy. So zakat money, instead of creating temporary dent in the consumption, it would create permanent source of income and consumption for the zakat recipients. One question comes to my mind, or it may come to the mind of any student. Those dear students, that question is how the fiscal policy basically began to function. As I mentioned in the start of this lecture, in the classical system, there was claim of full employment, there were no lapses in the economic activities, a complete linkage in the business, complete linkage of the different sectors of the economy, and the flow process of income is quite smooth according to the classical economist. So if there is any problem or disturbance, that is a temporary phenomena which is automatically removed at the later stage. So now what happened, this was the belief. What happened? Classical economy, actually the classical economic ideas totally failed, particularly in the US economy at the time of Great Depression in the 1930s. So after the First World War, there was widespread Great depression of the economy, when different economies failed to recover, particularly the US and the UK economies. They could not recover. Different explanations have been given by the economists for this, and one of the explanation was also given by the Keynes. Now, what explanation was given by different economists? Keynes and the Keynesian economists are of the view that this automatic recovery plan of the economy failed on the principle of liquidity preference, and then which actually turned into the liquidity preference, turned into the liquidity trap. Now, what is liquidity preference and what is then liquidity trap? So if you understand this, this is in fact the explanation for Great Depression, the failure of classical economic system. What is liquidity preference? Liquidity preference is the situation when people with the expectation of better opportunities in future, they start saving. They start saving out of whatever they are supplied. When money is supplied, people hold this money in cash instead of buying bonds, because the interest rate is falling. So if interest rate is falling, obviously it is not advisable to buy bonds, or it is not advisable to buy the assets, with interest-based assets which accrue income to the holders of bonds and certificates. Now, the monetary authorities then further increase the money supply. When they increase money supply, people once again hold cash, they don't spend. The interest rate further goes down. And according to the classical economist explanation, the money which is being held by the people should come back automatically. But if it does not come back, there will be a major crash in the economy. There will be a breakdown of the system. So this is what happened. When monetary authorities continued supplying money, the money did not matter, the money did not function at all. So people continued holding cash in the expectation that tomorrow, when interest rate goes up, the price of bond will be low, it will be beneficial to buy bonds in order to earn capital gains and the other returns on bond. But this did not function, and ultimately huge amount of cash was held by the people, and people did not invest. When this huge amount of cash which was held and which failed to come back to the system, this is known as liquidity trap or money trap. So liquidity trap situation is the explanation for Great Depression. So money was held, nothing happened, it did not recover, economies did not recover because simply that the money was held and it was not invested back into the economic activities. So this explanation was given by the Keynesian economist for Great Depression of 1930s, and there was Great Depression of 1920s as well. And now different options were discussed by the economists, how to handle the situation when there is when people are moving along the liquidity preference, and ultimately the situation turns out to be the liquidity trap. Although Friedman has given different explanation for this liquidity trap, we will discuss very briefly at the end of this lecture. So, Keynesian explanation, after giving the Keynesian explanation, the solution was discussed, how to come out of this situation when there is Great Depression. J.M. Keynes, the son of Lord, his father was member of the House of Lords in UK, and the rest of the story we actually do not have much time to, I don't have much time to share with you the rest of the story. The story is very interesting. If you are interested, you can read this story. If you search out your Google the life of J.M. Keynes. So if you search life of J.M. Keynes, 1936, so you will learn a very interesting story. Some of the economists declared Keynes as the person confronting schizophrenia. So schizophrenia, which means the person is not normal. He says something at one point in time and says something else regarding the same issue. So he explains one issue at one point in time in one way and explains the same issue in different ways at some other time. So I have read his book, and this is true to a greater extent that in his earlier chapters he explains certain situations, and then in the subsequent chapters he explained the same situation differently. Well, students, the story may be boring here to mention, but if you are interested, you can read it. Maybe it may be interesting for you as well. For me, it was very interesting. But that will divert us from the lecture on the fiscal policy. So the Keynes actually propounded the idea that government intervention can matter. If government interferes in this situation and government actually takes the initiative of launching projects, and if government launches the project, so through multiplier process the economy can recover. How? $1 spent by the government becomes the income of one part of the community or one person, and that person or that part of the community spend not dollar completely, but according to their propensity to consume, according to their attitude or habit of consumption. Maybe they spend 80% of this dollar and 20% they prefer to save, but at least 80% will be a push in the line of aggregate demand. So in every round, if people are spending 80% of their income earned and they save the remaining 20%, so at least this 80% every time, 80% of it, 80% of then the rest, and so on. So in the end, when we accumulate, it comes out to be some significant number. So this is how the economic activities can begin to recover. This explanation was given by J.M. Keynes, and this is how the economy can recover from the Great Depression. So dear students, now having given this explanation, I hope we are running short of time. Let me very briefly now share with you what explanation was given and what counter explanation, the answers or the replies were given by Milton Friedman from Chicago. Milton Friedman is of the view that people are not fool. People are not fool. They cannot continue holding cash. Naturally, if people are receiving cash, this cash in fact burns their pockets. In the sense, this cash motivates them, encourages them to spend. So if they spend, the economy can recover. There's no need for the government intervention. So Friedman explained the situation like this. He says, if people were holding cash, if people were given cash, they would spend more money and the economy will automatically recover. But this is the explanation given by Friedman and replies to the Keynesian explanation of the Great Depression. So whatever. So students, we will stop here. Before I close, let me briefly review and conclude our lecture. We started with the review of the previous lecture, and then with the introduction of the fiscal policy, I said change in taxation or the change in spending is actually the step forward to apply the fiscal policy. So change in tax or change in government expenditure mean the government has taken first step towards the fiscal policy, either expansionary or contractionary. If government has added taxes or reduced expenditures on various projects, or government has closed down the projects, this is known as a contractionary fiscal policy. And if government has decided to spend more money or cut taxes, obviously this tax cut or government expenditure provide relief to the economy. Economic activities start growing and people get job opportunities are created because of the expansion in the economy. This is what we discussed. Then we discussed the role of fiscal policy as automatic stabilizer. Some of the fiscal tools in conventional system and the tools in the Islamic fiscal policy framework which function as the automatic stabilizers. So how do automatic stabilizers function? Starting in reverse order, the transfers. What are the transfers? Zakat payment, the charity payment, donation given to the people, or some other financial assistance, or the assistance in terms of kind. These things actually promote, actually help the needy people, the have-nots. They push up their propensity to consume, they spend more, and automatically the economy at the time of recession is saved from depression. So recessionary situation can recover the economy out of this slowing down activities. And then in the conventional economic system, how the fiscal tools are functioning as automatic stabilizer, the taxation. At the time of boom, when people are earning more, they are receiving a lot of income. This rising income directly puts pressure on the aggregate demand. And this rising aggregate demand either will raise the price when the productive capacity is limited of the economy. And how this can be curtailed? Obviously, if the progressive taxes are levied, then certain increased part of the income is deducted, it is capped, and it goes to the public sector institution for the purpose of redistribution. This way aggregate demand is curtailed to an extent. Similarly, in the presence of zakat system, when at the time of boom many people are earning, their income rises, their revenues are increasing, and they are covered under the nisab, and when they are included in the nisab, in the people who are holding nisab, they will have to pay taxes and the government will receive zakat. They are liable to pay zakat, and this zakat money, when deducted, automatically stabilizes the aggregate demand and bridge the gap between aggregate demand and supply. The supply side gets relief. They get some time to grow to meet the rising aggregate demand. Then contractionary expansionary fiscal policy we have already studied, and I have briefed about the policy. Then we discussed different options of the state following fiscal policy, whether the state is fully Sharia principles based or it is a sort of mix. In some of the sectors, in some of the matters, the conventional or the Western law is followed, whereas in some other matters, the Sharia principles are followed. In both the cases, we quoted the case of example of Pakistan and Malaysia, where a sort of mix is being followed. But one thing is common in Malaysia and Pakistan, that zakat is regularly collected and distributed. It is collected and distributed by the state. So this is a good thing we discussed, and this increases the purchasing power of the people, particularly the redistribution of zakat. Then we studied how the fiscal policy in fact started. The fiscal policy started after the failure of the classical economics. In classical economics, the claim was full employment, automatic functioning of the market forces, and in case of gap, if any unemployment situation arises in the short run, that will be automatically removed after some time, and there will be no problem of unemployment in the long run. So in the long run, every economy will be experiencing full employment. But suddenly what happened after the World War, the system failed, the classical economic system failed, and different explanations were given by the economists, and one of the leading economists, J.M. Keynes, explained the situation as liquidity trap. The liquidity preference actually converted to liquidity trap, which is known as the Great Depression. And how to come out of this Great Depression? Keynes suggests government intervention. So if government interferes in the economic affairs, if government starts spending money, it will help the economy out of this Great Depression. How? When government spends money, it becomes income of the people. People spend according to their marginal propensity to consume, and this marginal propensity to consume is one of the components of the multiplier. So through multiplier process, the income of one person, the spending of one person becoming the income of another, then his spending becoming the income of others, his spending, and this a continuous cycle of generation of economic activities or the income actually functions as a multiplier, and the national income is increased. National income is increased by many times at the end of the day. This is how the fiscal policy can function to recover the economy out of recession, or it can avoid the economy from depression. So, well, what are the views of Islamic economists? And in the next lecture, dear students, we are actually concluding our today's lecture. In the next lecture, I will practically show you how the Keynesian system works, and when and where we can incorporate the Islamic items or the fiscal tools from Islamic perspective. For example, zakat, sadaqat, the charity, donations, and the other transfers which are permissible in Islamic framework, and how these tools, Islamic tools, function as a source of multiplier. So, without the graphical and the mathematical framework, it is perhaps difficult to understand. I know some of you may not be comfortable with the mathematical calculation, but this mathematical calculation is of very basic level, and I hope henceforth you should start paying attention to the diagram, which we will be discussing in the next lecture. So please be prepared to go through the Keynesian model from the macroeconomics books, because when I start next lecture, you will be better able to understand if you have reviewed the Keynesian model, the ISLM framework, the marginal propensity to consume. What is marginal propensity to consume? Basically, it is addition to the consumption out of increased part of income. So addition to the consumption when there is increase in income by $1, $2, $3. So that is marginal propensity to consume. So please just revise these concepts from macroeconomics. And remember, if you are not good in conventional fiscal policy, macroeconomic concept, then for you it will be difficult to understand the Islamic framework. Because we cannot focus the entire course on halal, haram, description. We have to have certain mathematical, graphical framework which actually is the practicable model. Because our ultimate objective of this course is to develop certain model which is understandable, which if you understand, you will definitely understand how the fiscal policy can practically function in Islamic framework. With these words, I hope when you come to the next lecture, you would have revised your concepts from macroeconomics, the Keynesian macroeconomic system in particular. The rest I will explain in the next lecture. So thank you. I hope this was useful. Allah Hafiz, and see you in the next lecture with further elaboration of the fiscal policy. Thank you.